Hey guys, welcome back to the Crypto Explorer channel. In this video, I'm going to share with you some of the best pools to start providing liquidity with a blue chip asset, none other than Ethereum, the second biggest cryptocurrency by market cap with over $400 billion allocated as of now. For the sake of this video, we will mostly look into pairs that have Ethereum paired with a stablecoin such as USDT or USDC, maybe a couple others, let's see, but these are the biggest also stable coins. Nonetheless, the best options will always be having Ethereum paired with the stablecoin, mostly because it will protect you much more against impermanent loss than even with having Ethereum paired with other blue chip assets, because the thing about the volatility pairs is that they are much more prone to impermanent loss. Even if you're talking about Bitcoin paired with Ethereum, that can also happen due to market volatility. Of course, at some point, sooner or later, you will suffer from impermanent loss when you are providing liquidity. Although this is not financial advice, this is just my opinions I'm sharing with you. But still, I always advise beginners to start with a blue chip asset paired with the stablecoin because of that. It will keep you much more protected against impermanent loss, and they also have a ton of volume. Think about it. Whether it be a bear market or a bull market, Ethereum paired with the stablecoin will always have a ton of volume, because in a bull market, people are taking profits or they are onboarding and buying some Ethereum for holding and waiting for price appreciation. So they're speculating on the price. At the same time, when bear markets are in, what's happening is that people are selling their volatile assets and locking their profits into stable coins because they feel it's much safer. So overall, these will be options that will operate and it will give you returns whether you're in a bull market, whether you're in a bear market. And if you're in a sideways market, it's even better because volatility won't be all that high and you'll just be smooth sailing, as I like to say. Since we're talking about the trading pair, what's going to happen is that people will pay fees to exchange Ethereum for a stablecoin, and those fees are what are paying you back. That's your reward for taking the risk of locking your funds into the liquidity pool. It goes for a really great way to generate passive income, and also in the meanwhile you're getting paid 50-50 in Ethereum and in the stablecoin of choice. So you can even choose to hold that Ethereum that you're earning from the fees, your Ethereum bag, waiting for price appreciation of Ethereum, or you can use that just to open more positions of liquidity, diversify your risk, open in different DEXes, for example, different pools on the same DEX, but use it also to expand your liquidity pool provision and at the same time diversifying your risk. Alright guys, let's start with giving you a brief example of what providing liquidity is with concentrated liquidity and how it works. So let's say you're providing liquidity for Ethereum token with the pair of Ethereum paired with the stablecoin, because like I keep on telling you in most of my videos, this is by far the safest option to keep you away from impermanent loss, and that is simply because you are only exposed to the price fluctuations of Ethereum. There's no other volatile token in the pair. So that's why I advise you to starting with providing liquidity with a blue chip and a stable coin. Also because if the blue chip goes down in value, highly likely you won't be wanting to sell it because you know it's a blue chip and you don't mind holding it long term. So that brings me to the first point I want to make. Provide liquidity to tokens which you don't mind holding long term, because if you see the price going down, highly likely you won't be tempted out to sell, or you don't get panicked to sell because it's a blue chip asset after all, and if you really believe in it, you know price will go up and you just sit and hold. Worst case scenario, you go out of range and you stop generating fees, but you sit and hold, because if you sell, if you opt out, then you are realizing your loss, just like when you sell any token at a loss. Let's say you bought Ethereum at $4,000 and now price is going down, you're gonna sell and you're gonna have a loss of roughly $540 right now. The same thing would happen if you would be providing liquidity. It's just the same type of game. But if you hold because you're bullish on Ethereum, you wait for that price to go back up, then you go back on range, you start generating fees again, as simple as that. That's how it works. Now you have to provide a range, you have to set your own range. And that's also why I do advise you to start providing liquidity with blockchains which are not Ethereum mainnet. That is a very costly blockchain to operate with. You can get gas fees costs of $20, $40, even $100 or more if the network is too busy. Not to mention also the time for the transaction to go through. That's why I always advise you, if you're a newcomer to the game, don't start providing liquidity on Ethereum mainnet. Instead, there's many other Ethereum layer 2s that are so much more cheaper. I'm talking about Polygon, Base, OP, AERODROME. 4 blockchains with a ton of volume, and they have also very, very cheap gas fees. We're talking about cents, if not fractions of cents. And gas fees are going to be the expenses of you setting up your liquidity pools with Ethereum or any other token for that matter, because you will pay gas fees very often. If you want to claim fees, you will pay gas. If you want to deposit a new position, you will pay gas. If you want to compound your earned fees into your position, growing your bag, you will pay gas. If you want to set a new position, you will pay gas. You're putting your money to work, you're going to have expenses, and gas fees will be your expenses. That's why I don't advise you to go on Ethereum mainnet straight away, because you're going to do some mistakes probably until you understand clearly how this works. But of course, you can also make those gas fees back in fees from your provided range. If you know what you're doing, you can do those in a day, in less than a day, it depends, but highly likely you can do those if you know what you're doing. That's why I say keep away from Ethereum mainnet straight away. Keep yourself providing liquidity with more low cost blockchains, just the ones that I just mentioned, all right? Now let's talk about the range. Right now the price of Ethereum is $3,458. Let's say you want to set up a range of $3,500 on the upper end, and on the lower end $3,400. This is a very tight range. You probably will go out of range very often. The point here is not showing you which range you want to choose, because that will depend on how risky do you want to go. But this is just an example so that you understand that if Ethereum price goes above $3,500, you will stop generating fees and you will be paid fully in the USDT token. If the price of Ethereum drops $3,400, you will stop generating gas fees and you will be paid fully in the Ethereum token. What I mean when I say you will be paid fully is just that if you want to go out of your position, you will be having 100% of your assets paid back to you in Ethereum. And the same is also true if the price goes on the upper end of your range. You will get paid fully in USDT. And basically, if you go out of range on the upper end, you'll be selling Ethereum at the profit if you want to opt out of your position. Also, if you are going out of your position when Ethereum is below your lower range, then you will be buying the dip, and in the meanwhile, you've been generating fees. So let's say hypothetically you don't generate enough fees to cover your costs for providing liquidity, for deploying the position and going out of the position. In that case, you will lose money. Alright guys, I believe this explanation is very simple, straightforward. Now you understand briefly at least how it works when providing liquidity. Also worth mentioning that the fees that you will generate when you are within your set range, they will be paid half in Ethereum, half in your stablecoin of choice. Now let's take a look at some of the decentralized exchanges you can use to provide liquidity. Alright guys, what's going to happen is that we're going to take a look at some of the best DEXes across chain, and there's a couple we're going to focus at. Here on DeFi Llama, it's showing us the top protocols, and among DEXes we have on Ethereum, it's Uniswap v3, but again, we're not going to take a look at Ethereum's pools because of the reasons I mentioned before. Alright, so when it comes to Binance, we're going to take a look at Pancakeswap. AERODROME, it's showing the biggest DEX to be Uniswap, but they also have Camelot, which is a major liquidity hub, and it has also really great pools to explore there. On Base, there's AERODROME v1. They rival Uniswap. They have much higher TVL usually. So alongside with Uniswap, AERODROME is also an excellent choice for you to liquidity provide on base chain. When it comes to Polygon, although Uniswap is showing here, again, we're going to take a look at another which does really well on Polygon, which is Quickswap. For optimism, it's showing Velodrome v2, and Velodrome operates just the same as AERODROME. They're basically the same protocol, but since Optimism it's an Ethereum layer 2, you will also get a ton of really good pools if you go with Uniswap. Now from here you can already tell Uniswap v3 works excellently across the board. On Ethereum blockchain and on Ethereum layer 2s, it will provide you some of the best liquidity pools out there. Then it's just a matter of your own preference or just seeing what's having higher volume if you're going for that higher APR all the time. And the beauty about providing liquidity is just that. You can unlock your funds at any time and move from DEX to DEX, from chain to chain. You have complete freedom to allocate funds as you see fit and operate with any DEX of your choice. Let me just add that all these protocols I did full-on in-depth breakdowns to help beginners to start to operate with them, and I will link the videos for those protocols all down in the descriptions. So if you want to get more acquainted with every DEX and know more about how they operate, feel free to check those resources as well. But right now, let's jump into Uniswap, the biggest DEX in DeFi, and see what they offer when it comes to liquidity pools on all of these chains. And by the way, Uniswap also has a mobile app. So if that's your thing, and if you want to have Uniswap on the go, it's always worth to install it on your device and use it there, of course. So here we will go at the Explore tab because it shows us all the analytics. As you can see, the V3 version has a ton of volume because it's so much more rewarding and capital efficient that it's the meta of providing liquidity in DeFi. So let's go on and see the best pools to provide liquidity, and highly likely you will see Ethereum paired with a stablecoin being ranked on first, top 3, top 5. So here we're taking a look at the pools, and we will go and do the following. We will sort all of these pools out by 7-day volume because we want to see the ones who have a best track record for the near past. And here on Uniswap, they only give us the past 7-day volume. And the thing you want to look at is the day APR. The higher the better. It's paying you the most. And the daily APR will always reflect the volume to TVL ratio. So the higher the volume compared to the TVL, the better. As you can see, the first pair is USDC paired with Ethereum with the 0.05% fee range. So this means that whenever people trade this specific pair on this specific pool, they will pay a fee of 0.05% on their volume of trading. A percentage of those fees will pay to liquidity providers, and that's how your APR is generated. If you notice a specific pool that has a volume that is double the TVL, for example, that's roughly the case here with this USDC ETH pair. This is already a printer. This is over 2x, a little over 2x volume to TVL ratio, but it's already a sign that it's going to pay you handsomely. And you can see the same here for ETH paired with USDT, the second highest traded token. Daily volume is roughly 6x of the TVL. So you see the daily APR is almost 3 times higher. So you see the trend here. Volume to TVL ratio is a huge metric if you're looking for the higher APRs and the pools that are basically paying you the most, generating the most fees. And altogether, both of these pools are also very deep when it comes to liquidity, so they are really good options. Deeper TVLs are much better because when facing higher trades, they won't be affected by slippage all that much. So in these specific cases, what we are looking at, there are different pools, of course, they have different stablecoins involved with Ethereum. They are on the same fee range. And actually the first one has more transactions than the second, but the difference that is making the second one to pay the highest APR right now is that they have a better volume to TVL ratio. So their TVL is lower and they're having a higher volume. It's almost 6 to 1. While on the first case, the first pool, the most traded pool, you will see that the volume to TVL ratio is roughly 2 to 1. So you see, the higher the ratio is, the better payouts in APR you will get. But altogether, you will see that this is a trend that will set for every blockchain. Right now we're looking on Ethereum just because I wanted to show you that these specific pools that I label the best one for beginners, they will work cross chains, cross DEXes. You're gonna see a pattern here. They are going to be the top 3 trading pairs, the top 5, worst case scenario, top 10. But they will work across the board as I will show you. Now let's switch up here for the OP network. And there you have it. First most traded pair, USDC paired with ETH. And the second is also the same pair, but in this case it's ETH paired with USDC. And their daily APRs is even higher than on Ethereum. So let's take a look now at BNB chain. The same thing applies. You see here Ethereum paired with USDT is the second most traded pair, but I don't like this fee range. This fee range tends to be not optimal when it comes to generating fees. I like the 0.05% much better. So let's see if we can find here, and here it is, the 8th most traded pair, ETH USDT, 0.05% fee range, 1-day APR 0.21%. So you see the volume to TVL ratio is also really good on this one. And basically this one will pay you, if conditions stay like this, 1% every 5 days. Conditions in DeFi, they will fluctuate. It depends on volume, on how markets are operating, and these will fluctuate. It will be higher some days and lower in others, all right? But as you can see, again, we have on the top 10 trading pairs, Ethereum paired with a stable coin. And right now on Polygon, let's see what we have. Actually, the first 2 most traded pairs involve Bitcoin, and on a side note, Bitcoin tends to do really well on the Polygon network, so also worth to check it out. Especially this pair, Bitcoin with the stablecoin USDC, it tends to do really well on Polygon. But the 4th most traded pair again, USDC paired with wrapped Ethereum. So you see the pattern still applies. Number 6, we have again USDC paired with, in this case also wrapped Ethereum, the same fee range, but a bit higher APR. And the difference comes to the volume to TVL ratio. As you can see, on the first one, the 4th ranked pair, you have a TVL of 2.9 mil, a daily volume of 7.4, and on the 6th ranked pair, you will have a lower TVL and a bit lower daily volume, but overall the volume to TVL ratio is higher here. So that's why you get the higher daily APR. Let's move on for base network now. And all of these blockchains, they will have different volumes daily, but overall they're doing all really well. They all have a ton of volume, like I said before, and here on base, number 1 most traded pair, Ethereum paired with USDC on the 0.05% fee range. Daily APR 0.3%, so this has been a winner for the past months for me. In 3-4 days you can get 1% on your LP position. So let's move on to Arbitrum. And again on Arbitrum, the pattern still applies. You see ETH paired with USDC on the second most traded pair with a daily APR of 0.3%, and also ETH paired with USDC with a daily APR of 0.17%. Now, as you can see, Uniswap works very well cross chains across the board. It's going to be a very reliable option. Now let's take a look at the second biggest DEX in DeFi, which is Pancakeswap, and they will have specifically great pools for BNB Smart Chain. So in here, you'll have really good options for pools in the BNB Smart Chain and also Arbitrum and Base Chain. So let's take a look at all of those 3. Right now, we are looking at the Binance Smart Chain top trading pairs. Again, we'll sort the volume for the 7 days. So since this is a blockchain which the native token is BNB, ETH will not be one of the top 5 traded tokens most likely, although it can be there. I've seen it before. And here it is. Wrapping up the top 10, Ethereum paired with USDT. It's going to be very rare that they will drop down the top 10. Usually they are mostly among the number 5 or 7 traded pairs. Sometimes it could go even upper and be a top 3, but like I said, since this specific chain has BNB, has their native token, it's going to be a different thing than all the others that we just took a look at. But still, now let's see what Pancakeswap does offer on the Arbitrum 1 network. And the top pairs here we have wrapped Ethereum paired with USDT on the 0.05% fee range. It's ranking the 4th. It has a really nice volume to TVL ratio. So the main difference from Pancakeswap to Uniswap, as you can see, it doesn't give you the daily APR. You need to do the math yourself. So in this case, you will have to just account for the volume to TVL ratio yourself manually. But in this case, for the past day, the volume has been 4x the TVL, so definitely it's printing. But again, it shows you how reliable this pair of tokens is. Now let's move on to all the pools for Pancakeswap on Base. And we have ranking on the 6th spot, wrapped Ethereum paired with USDBC, which is a specific token for the Base chain. This specific stablecoin, you will see it a lot here on Base chain liquidity pools. Doesn't really matter what DEX it is, but we will see this showing up a lot. And it's performing better right now than Ethereum paired with USDC. But overall, to be honest, I think if you want to provide liquidity on Base, you're much better with Uniswap, AERODROME, or even Sushiswap. Now we're taking a look at Quickswap, and this is going to be a very good option for providing liquidity on the Polygon network, alongside Uniswap of course, but sometimes in here you'll get even better pools. Of course, you can also deploy at both DEXs at the same time and diversify your risk just like that. But once again, sorting the pairs for the 7-day volume, you'll see that we will have USDC.E paired with Ethereum, very well positioned, the number 3 most traded pair for the past week. Also, we have a bit lower down here, USDC paired with Ethereum again. And if you notice that you see APR and also farming APR here, the main difference is that the APR just addresses the fees being generated, while the farming APR, it addresses when you stake your LP position onto Quickswap's farms, and then you start to earn on top of the fees the Quick token, which is the native token of Quickswap. This is a feature that other DEXs also include. Uniswap does that with the Uni token, Pancakeswap does that with Cake, and many others also do just the same thing. But you do not need to lock your tokens into the farming pools to earn their token. This is a bonus on top of it, yes, but just by providing liquidity, you'll earn fees from the APR naturally. And notice how the fee range here on these top trading pairs, it's even higher. It's much higher than 0.05%, actually is more than double than that. So it means that even with fewer trades being transactioned, the fees are higher, and sometimes it's not all that attractive to traders, but right now these pools are performing particularly well and they are paying well above the average. So this goes to show you that also Quickswap on Polygon is a really good option. They do offer other chains here, but Quickswap tends to do super well on Polygon. Now let's take a look at Camelot. This is a huge liquidity hub on Arbitrum, so it's also going to be a really good option if you're providing liquidity on the Arbitrum network. We are already looking at the V3 version, so let's take a look at the top pairs. Once again, I did sort the pairs by volume for the past week, the past 7 days, and number 1 ranking on the list, Ethereum paired with USDC. You see that Camelot does show their display a bit differently. They show you the fees generated for the past 24 hours, and they give you a projection of 1 year's worth of fees. Lower down the list, you also have ETH paired with USDT. But once again, you have the same pattern, and you will see Ethereum paired with the stablecoin being the top traded pairs. The 1 year fees to liquidity ratio is going to be always a projection for whatever the fees have been for the past 24 hours. So always do take that in mind. And by the way, all of the things that they will show you here, the current APRs, will be a projection based on past metrics. So it's not a guarantee, it's just showing you the current trends for the market. Now we're taking a look at Sushiswap. In my experience, this will always be a very good option for every Ethereum layer 2, for example. So here on the filters, we just searched from all these networks. I included ARB, Base, Polygon, and OP. Like I said, they tend to do really well on these chains and offer very interesting pools. So let's go ahead and check that. In this case, I did sort this out for the volume for the past month. The most traded pair is Ethereum paired with BRET on the V2, but we're not interested in that right now. We're taking a look at Ethereum paired with USDC, as you can see, which is Sushiswap V3, concentrated liquidity version. And look at this APR. This is very close to 1% a day, so it's a really great one. And by the way, this filter is something that DEXes will tweak here and there. Not all DEXes will offer that. Sushiswap does. It's one of the different features that they offer. Now, the other DEXes do not offer the possibility to sort all of these pools straight away from different blockchains. You'll have to go manually from one chain to the other, and that's why we didn't do that before. But you can see the little icon here after the pair. It shows us which chain we are looking at, and in this case it's Base. Another Ethereum stablecoin pair here on the V3 in this case is USDBC. So by now you already know the deal. You already know what you should be looking out for, the higher paying pools and the more reliable ones. So for that reason, we'll stop scrolling down just now and take a look at some other DEXes. And like I said before, AERODROME is an excellent option if you are wanting to provide liquidity on the Base network. For that reason, let's take a look at the most traded pairs here. So on concentrated liquidity, we have number 1, wrapped Ethereum USDC. You can see the volume to TVL ratio here is off the charts. The APR is on the 4 digits, which is truly insane for a stablecoin paired with the blue chip asset. So the second most traded pair is going to be Ethereum paired with USD Plus. Let me just give you a side note on USD Plus. This is a stablecoin that you might not have heard about as of now, but they are from the overnight finance protocol and they are a rebase token. So if you provide liquidity to this pool or any other that has USD Plus, actually, the nature of USD Plus is that it's a rebase token. So when you are minting it, they are using the money that you minted the token to generate more revenue. This is something that I do explain in more detail on my overnight finance protocol walkthrough. I will also link that down below if you want to check it. But even when you have your tokens deployed on a liquidity pool, the nature of overnight protocol will allow for the token number to accumulate just like that. So you might want to take a look at the video, understand more about it, because in my opinion, it's one of the best protocols right now across DeFi. And by now, we could kept on scrolling and showing you some more pools, but you get the picture. I just showed you that cross-chain, cross-DEXes, Ethereum paired with a stablecoin will be a winner pair for you to provide liquidity, generate fees, start establishing your DeFi portfolio to work for you while using very known and reliable protocols. For example, Uniswap never has been hacked. So when it comes to safety, these guys are on top of the league. And you're just using mainstream applications, super reliable, well-known DEXes. So if you have any questions, drop them down below in the comments. I hope that this video did clarify and help you understanding more about liquidity pools and how you can establish some really reliable passive income from all of these positions. You just have to choose your chain of choice or even diversify across chains, across protocols. That would be also a really solid way to start generating passive income. So if you enjoyed this type of content, guys, like and subscribe for more. Thank you for watching. Stay safe. You know how crazy crypto can get, and I'll see you on the next one.